Welcome to The Explainer. Today, we're diving into a powerful playbook for what is, let's be honest, one of the trickiest parts of trading, spotting a trend reversal before it actually happens. We're going to break down three really distinct strategies from the mind of analyst data trader, all designed to give you a serious edge.
Okay, let's kick things off with a feeling I am sure we've all had. You see a chart just screaming upwards, you get that FOMO, you jump in with a buy order feeling like a genius, and then bam, the price tanks, and you're left holding the bag at the absolute worst possible moment. It's frustrating, it's painful, but you are definitely not alone.
So here's what we're going to do about it. The whole point of this explainer is to give you a clear, step-by-step approach so you can start spotting these reversals ahead of time. We're going to shift from just reacting to what the market does to anticipating its next move. That way you can avoid getting caught and maybe even ride the new trend down.
All right, let's build our foundation here. Before we can even think about using a strategy, we have to be absolutely crystal clear on what a reversal is, and maybe even more importantly, what it isn't. Look, on the surface, the definition is super simple. A reversal is just when the market changes direction. An uptrend flips and becomes a downtrend, or the other way around. Simple enough, right? But, as we all know, seeing that exact pivot point happen in real time, well, that's where the real challenge is. Okay, now let's talk about the single biggest, most expensive trap when it comes to reversals. It's that little voice in your head that gets so many traders in trouble. You see a price that's gone parabolic and you think, it's gone up so much, it has to come down now. Thinking like that is basically a recipe for disaster.
And why is it such a trap? Because you're essentially trying to stand in front of a freight train. When a price is consistently making higher highs, that upward momentum is incredibly powerful. Trying to short that is like trying to stop a giant boulder from rolling downhill. You are literally fighting the strongest force in the market. And you have to remember the golden rule. Prices can always go higher than you think they can.
So, if we can't rely on our gut feelings or just wild guesses, what do we rely on? A system. We need a system. So let's dive into our very first strategy. This one is all about spotting a crack in the market's foundation, something we call the structure break. The structure break is a really disciplined, three-step process. First, you find a nice, clear, established uptrend. Second, and honestly this is the hardest part, you sit on your hands. You do nothing. You have to patiently wait for the price to actually break below that trend line. And third, even then, you still wait for one last piece of confirmation that the bulls have officially run out of steam. So what does that final confirmation actually look like? Well, this is where we look for hard evidence. Just breaking a trend line isn't quite enough. That could just be a temporary dip, a head fake. We need more. You want to look for something like a double top. That's when buyers try to push the price to a new high, fail, and then try again and fail a second time. That's a huge sign of exhaustion. Or, even better, you see the textbook definition of a new downtrend. The price starts making lower highs and lower lows. That's your signal. All right, let's move on to our second strategy. This one is for those times when the price doesn't so much break through a level, but instead slams into a wall and bounces right off a historical point of resistance.
The process here is just as disciplined. Step one, you have to become a bit of a market historian. You look to the left on your chart and find a strong resistance level, a price ceiling that has stopped rallies cold in the past. Step two, you wait. You let the current price climb up and approach that ceiling. But, and this is key, we don't just guess it's gonna hold. For step three, we bring in a specialized tool to get confirmation.
So why bother with an indicator? Simple. It takes the guesswork and, more importantly, the emotion right out of the equation. It gives us an objective signal based on data. For this strategy, we need a tool that can look under the hood of the price action and tell us what the momentum is doing right at that critical make or break level.
And the perfect tool for this job is the stochastic oscillator. What this indicator does is it helps us see when an asset might be overbought, which is just a fancy way of saying that the buying momentum is getting exhausted and it might be ready to turn over.
Now listen up, because this is the single most crucial detail, and it's where most people go wrong. The signal is not when the indicator goes into the overbought zone. That just tells you the market is stretched. The real entry signal, the one you wait patiently for, is when it crosses back down and out of that zone. That's the confirmation that selling pressure is finally kicking in and taking over. All right, time for our third and final strategy. For this one, we're pulling out a true classic,
A momentum tool that I'm sure many of you already have on your charts, the Exponential Moving Average, or EMA.
The setup here is really straightforward. We're going to use two EMAs, a fast one set to 10 periods and a slightly slower one set to 20. When that fast 10 EMA crosses above the slow 20, that's a signal that we're in an uptrend. And, you guessed it, when it crosses below, it signals a potential downtrend.
But, and this is a huge but, you have to be careful. Here's the warning that comes with any moving average strategy. In a choppy market, one that's just bouncing around sideways with no real direction, this crossover will fake you out over and over again. It will give you tons of false signals. That's why we never use it by itself. The key is to think of it as a confirmation tool, not the reason you take a trade.
So, we combine what we've learned from our other strategies. The process starts out exactly the same as strategy number 2. You find that key resistance level, and you wait for the price to come up and test it. But here's the difference. Your confirmation signal is the EMA crossover. You wait for that fast 10 EMA to cross below the 20 EMA, which confirms that momentum is shifting to the downside right at that critical spot.
Okay, so there you have it. 3 distinct, rule-based strategies for spotting a potential reversal. Now let's put it all together into one complete toolkit so you can really see how they all stack up.
You should think of this table as your new cheat sheet. The structure break, that's your go-to when you're in a really clearly defined trend. The key level strategy, perfect for when the market is coming up to a price that has acted as a major ceiling in the past. And the moving averages, that adds an extra layer of momentum confirmation right at that key level. The important thing is that each one gives you a clear concept and a very specific, non-negotiable confirmation signal.
And that brings us to the final and I think most important takeaway. Just knowing this stuff isn't enough. Information doesn't equal transformation. True skill comes from mastery. The goal here isn't to try and juggle all 3 of these at once. It's to pick the one that really clicks with you, study it, backtest it, and make it your own. So the question I'll leave you with is, which one of these tools will you master first?